In this video, I'll break down Monday's regular DR session on crude oil and show you how no other strategy comes close to this kind of precision, even using just the basics I teach here for free. Stick around till the end if you're serious about leveling up as a trader. You don't want to miss this one. As always, before positioning yourself, it's important as a professional trader to make informed decisions and analyze the current price action in a proper way. This helps with strengthening the foundation for a potential trade. At first, you should get an overview of the overall market structure in terms of DR models. Crude oil started its week with what seemed to be a DR downside model, but the overnight DR session confirmed long violated the ADR mid, which lowers the probability for the DR downside model to continue. Few moments later, the ODR violated the aftermarket session high, excluding the DR downside model and therefore increasing the probability of a DR range expansion model or trumpet-like price action throughout the day. That's a very crucial information given to you already at 5:50 a.m. Imagine that. Then the RDR forms and it's evident that each DR session expands the previous one in its size. To be precise, use a range tool to measure the ticks from the IDR high to the IDR low. A DR range expansion model is intact, which already gives a possible target of one standard deviation, but we don't know in which direction yet, since price hasn't confirmed into any direction yet. Right after the box has formed, the confirmation happens to the long direction with the 10:30 a.m. candle. Extra bonus here, the DR box is green, indicated by the closing price being higher than the opening price. After that, we, as always, access previous DR session levels that can be helpful with our decision making. There is not really any DR session level from prior days or weeks. That's why we will highlight the ones from the most recent sessions. On top of that, highlight volume and gap imbalances and make them, as well as previous DR session levels, easily accessible to toggle on and off when needed. Without anything else, that looks already very promising for a potential DR basic trade. Now we will add some statistics and historical data to that, just to demonstrate how a proper high probability trade setup with the basics already can increase to even higher probabilities. Monday's regular DR sessions on crude oil with a long confirmation between 10:30 to 11 a.m. have an almost 80% probability that the DR session will not close below the defining range until 4 p.m. New York time. There's an 83.3% probability for a retracement back into at least the defining range, and a 70% probability for a retracement back into the implied defining range. These numbers already strengthen the idea of a potential retracement. Going deeper into data, it shows that most maximum retracements for the session started at 10:45 a.m. if the session held true. 11:30 a.m. marks the time where 50% of max retracement were done historically, while 12:30 p.m. marks the 70th percentile. This can be classified as your strict entry time window, and no entries should be taken after 12:30 p.m. since it has other probabilities. But let's think about that for a moment. We know from the past for this exact scenario, 70% of all maximum retracements in a true session happened up until 12:30 p.m. That's a major statistical advantage. By narrowing it down to that specific time window, we can analyze where price had its maximum retracement in that time window most frequently. Plus 0.09 up until minus 0.1 stand out clearly as the levels. Price had its maximum retracement for the session most frequently. The median max retracement, which marks 50%, sits at minus 0.2 and can be included into the first retracement area, as the stop loss placed below would cover the area, where historically 50% retraced into. Since you would cover most of the 0.2 to 0.3 area with your stop loss for the first entry, the area for a potential second entry would therefore start from minus 0.31 up until minus 0.5. Minus 0.5 marks the 70th percentile. Your stop loss placed below would cover 70% of historical maximum retracements that happened under all these criteria. What a beautiful edge. As a target, we have 1.2 standard deviations as the 70th percentile, but coupled with the DR Basics teachings, we always expect one standard deviation to be reached in a DR range expansion model, and data-wise, this target has been reached even more than 70% historically. In my opinion, that looks perfect, well prepared to attack the session. Now that you're set up as a trader, you can turn on previous DR session levels as well as volume and gap imbalances and wait for the entry time window to start and hopefully retrace into one of our predefined retracement areas for potential trade setups. Price starts to retrace back into the defining range, and right at the 10:45 a.m. candle, it offers your first entry. Remember, we have an 83.3% probability for a retracement back into the defining range at least. This explains why we don't want to enter at the plus 0.09 level, as it's located outside the defining range. Small but crucial detail that can make a huge difference over the long run. Your position gets filled and the trade is running. Price rejects the IDR high and closing price pushes higher, but fails to extend towards the 1 standard deviation level before stopping you out. But this is where it gets even better. The candle that stopped you out on your first position fills the second trade if entering one tick above the second retracement cluster. This entry now not only covers almost 70% of max retracement times, but also rejects the aftermarket DR session high to the tick, and your stop loss covers an important gap imbalance and 70% of historical max retracement levels as well. Almost 5-hour upside potential for that trade, and everything is well calculated. Price accumulates, hits the retracement area once more and extends to the target of 1 standard deviations, as it should ideally be in an ideal DR range expansion model. Just to let you know, this trade was accessible to everyone, and even with my DR basic teachings, a trade worth taking right here. Last but not least, look at the following 2 days of price action with your initial DR levels from last week and gap imbalances highlighted. Amazing rejections, I would say. I hope you found this insightful, and if you're interested in learning how to trade with a data-driven statistical approach, then feel free to visit M7DR.com for more information. Have a good trading week, and I hope to see you in the next video.
We're gonna take on the world.